Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, we'll have full market coverage ahead as U.S. stocks open in the green. Plus, we'll have the latest on the government shutdown with the House poised to end the record-long closure. And we'll sit down with the CFO of Circle as the stablecoin issuer drops. The shares drop despite a strong earnings report. Let's take a look at the major averages right now because we are seeing a mixed picture after some initial strength in futures and out of the gate here this morning. We're seeing the Dow higher by about 450 points, about 1%, the S&P higher by about 1/5%, but then you've got the NASDAQ that is now trading lower by about 1/5%. So seeing this divergence that in the futures market was seen benefiting the NASDAQ, but now we've seen really things turn on their head. So if you look at the sectors that are on the move in the S&P 500, you've got energy down, real estate down, communications services, and then financials and healthcare are helping lead the gains here. So that's the sort of balancing act we're looking at. But as always, feels like it comes back to the AI trade, and there we're seeing a little bit of stress here this morning. Not any big, huge declines, really. There's not a lot of dark red on this screen here today, but we are seeing some of the big tech majors that are falling in today's session. Doesn't seem to be necessarily a catalyst. It just seems like the AI sentiment as of late has been a little bit more delicate than it had been. So that seems to be contributing to a little bit of an uptick in volatility in many of these names. Let's talk more about the sort of policy backdrop here as well, the macro backdrop, because the full House of Representatives is expected to vote on the funding bill to reopen the government. That's after the bipartisan deal cleared the House Rules Committee. Joining me now is Washington correspondent Ben Wershkul and John Hilsenrath, StoneX senior advisor and Yahoo Finance contributor. Ben, I want to start with you and on this latest and what to look for as we watch this process of reopening the government.
Yeah. Morning, Julie. So it's sort of a question at this point with the shutdown of when, not if, this is going to end. The timing here is that the House of Representatives will come into session at 12 noon today. This is actually the first time the House has been in session in 54 days. There'll be debates all afternoon. The House Majority Whip, Tom Emmer, promises that the final vote will come before 8 p.m. Eastern tonight. I'll believe that timing when I see it. These things tend to get pushed later and later into the evening. But the bottom line here is that the House appears to have the votes to get this deal done and send it to the president's desk. House Speaker Mike Johnson was just talking to reporters a couple minutes ago and offered another batch of optimistic commentary that he has the votes. He's very optimistic about the vote tally there. This is the deal that the Senate passed a couple days ago to extend the government, keep the government open until January 30th and keep some wings of the government open even longer than that through the end of the fiscal year. There's also some limitations there on President Trump's ability to fire federal workers and some other provisions like that. But this does appear set to be, by this time tomorrow, the government should be reopened with President Trump offering his support and kind of ready to sign this when it's to his desk.
There's reopen, Ben, and then there's reworking, like get all back up, firing again on all cylinders. And of course, for the markets, most pertinently, when are we going to get the data again? And most pertinently for the Federal Reserve, do we know anything about that cadence?
We do. We have some clarity there. I'll take jobs and inflation in order, but the bottom line for both is that there's going to be a lag here in those going forward. On the inflation side, what the White House has been signaling for the last couple of weeks, and a White House official reaffirmed to me just this week, is that we're likely never going to get October inflation data. That's because the way inflation data is gathered is surveyors are in the field looking at prices in real time, and that's simply wasn't happening while the shutdown is taking place. So that was scheduled to be released this week. Not going to happen. Not going to happen at 8:30 a.m. tomorrow, and likely never going to happen. The question on inflation is what November data looks like. Obviously, these workers will be coming back in, presuming this passes, and then the question is what surveyors are going to be able to get in the next couple of weeks to tell us about the November inflation picture. On the jobs front, we are going to get some older data relatively quickly. That's the expectation, is that September jobs data will be quick. That'll be out the door. That was already in the can essentially when the shutdown began. So once the workers are back, they can finalize that and get that out the door is the assumption. October as well as November data is up in the air. It's a matter of these workers getting back and sort of figuring out what's available. There may be ways to recreate some of it because this is business survey data. Business owners respond to this. So there might be ways to kind of backfill this, but that, I think the expectation there is it's going to take some time before we get clarity on that front as well.
So, John, what does all of this then imply for the Federal Reserve if, especially as it looks like there is a divide within the Fed in terms of those who are more worried about inflation and those who are more worried about the labor market?
Yeah, I mean, it means that the Fed is going into its December meeting where there's already a lot of division and disagreement about what to do with, to use Jay Powell's words, a fog that still hasn't cleared. So, by the way, that was a great overview of the data outlook. We're not going to have inflation data for October. And I'll say for November, those inflation numbers are reported to the BLS over the whole course of the month. So we're almost halfway through November without price data having been recorded. So even if we get inflation data for November, it's going to be somewhat tainted. And then the other problem that the Fed has, so the Fed has a dual mandate, stable prices and maximum employment. Their main data points are the inflation rate and the unemployment rate. The unemployment data are also tainted because that's also based on surveys, in this case of households, that were not conducted in October and that are supposed to be conducted by the BLS this very week in November. So October, November data for the two most important reports that the Fed looks at, inflation and unemployment, are going to be tainted. The Fed is in a fog. And that gives the bottom line here, that gives officials some incentive to say, all right, let's just wait until we get to January when the fog has cleared a little bit before we make another decision about what to do on rates.
And January is a little bit closer to February, and we have just learned that Raphael Bostic is going to be retiring when his term is over at the end of February, John. What does that do to the dynamic within the Fed? I mean, we know that Chair Powell's on his way out as chair as well.
Yeah. Well, Bostic is not a voting member of the Federal Open Market Committee in 2025 or in 2026. So it isn't. So there are only 12 of the 19 officials who attend these meetings on some rotational basis who participate in the actual votes. So this won't affect the voting that happens at the Fed meetings, but I think it is representative of growing kind of discord that we're going to see in the central bank, new faces in 2026, and potentially more disagreement about how to proceed on interest rates. And and Bostic is one element of that. By the way, the Fed board votes to re-up every regional bank president it's either February or March. So, there was some concern earlier this year that if Lisa Cook, a Fed governor, was removed from the Fed, that there might be enough governors to start firing some of these regional bank presidents. It doesn't look like that's going to happen. But I think we're going to have a Fed that looks a little bit more like the Supreme Court in the years ahead, in the sense of you're not going to have 12 unanimous decisions at this central bank. There's going to be disagreement, which the market is going to have to parse through.
Well, and John, does that also imply, if it looks more like the Supreme Court? I mean, the Supreme Court is now is seen as more weighted in favor of this administration. Do you see the Federal Open Market Committee going in the same direction?
Well, clearly, this president is going to put people on the Fed board who he approves of, and the Fed board has a say in the successors of these regional banks. So yes, I think that there's some movement in that direction, but there's also a lot of inertia in the institution. So I don't think, at the Supreme Court, it was a very slow-moving process.
Right.
It took decades. And I don't think this is going to happen overnight at the Fed. I think what we're going to see is a lot of disagreement in the course of 2026.
All right, buckle up. Ben, John, thank you so much. Appreciate it. And for more perspective on the economy, you should tune into Yahoo Finance Invest. It's tomorrow, November 13th. We'll be talking to Lael Brainerd, former Federal Reserve Vice Chair and former Director of the National Economic Council. She's one of the many folks we'll be talking to tomorrow. In the meantime, investors have expressed concern over the meteoric rise in total spending of construction on construction of AI data centers. That's expected to reach $1 trillion by 2030. Now that angst has been spilling over into the bond market to some extent as well. For more on that and what the bond market is projecting for 2026 as well, is Brian Whalen, TCW Chief Investment Officer and Generalist Portfolio Manager in the Fixed Income Group. Brian, it's good to talk to you. It's been a while. And I do want to start, we'll definitely talk about the macro sort of Fed big picture in a moment, but I do want to start on the explosion in debt that we have seen to fund these data centers, right? We've seen some big offerings as of late, and they are, in some cases, more creative than some of the structures we've seen in the past. So we've had a lot of bubble talk on the equity side. I'm curious your thoughts on the fixed income side.
Yeah, that's a great question. I think, first of all, these large deals are coming from companies with incredibly strong balance sheets. So, on the good news side, we're seeing all this issuance, which make you concerned about the leverage of the underlying companies. But a lot of these are the big tech names that you had up on your equity board, just there, like Meta and Oracle and names like that. And so they're doing these deals, they're giant deals, they're 20, 30, 40 plus $1 billion transactions, but the net debt as it relates to them, who are at the end of the day, the obligor on the hook, they still look very, very sound. On the other hand, outside of the corporate bond market, there's a ton of money being spent and raised from smaller companies in, let's say, the asset-backed market. And so, we don't really have a question about where AI is going to take us as an economy, as a society. It's about like the pace at that. And are we getting too ahead in terms of building? And if that's the case, sure, some of these large bond deals that are coming from these very strong, sound companies, they're probably still going to be fine because you got that strong obligor to make your payments. I think the question will be about some of the smaller ones. Are they left behind? Are they unable to meet their debt obligations? And what does that mean to those transactions that they took out of? So, as an investor right now in our conversations we're having real time, it's like trying to pick the winners and the losers in a very rapidly growing, robust space.
And the fact that we are seeing spreads widen above treasuries to some extent for some of these deals, does that reflect that the market is appropriately cognizant of the potential risks here?
First of all, I'd start with this. Credit spreads are really tight. Mm-hmm. So basically across corporate bonds, whether they're investment grade corporate bonds or high yield bonds, they're very tight. In other words, you're getting paid historically very little amount of extra yield relative to treasuries to take that risk. So yes, these deals that are coming with a healthy premium or a little bit of extra yield than you would expect over your standard corporate bond benchmark. But relatively speaking, you're still not getting that much paid very well for corporate bonds. And I would also say, like, some of this extra yield and this compensation on these big AI data-driven deals, some of those were in the earlier deals, and they had been in kind of arrangement and been talked about and worked on for close to a year. And so the investors that were participating early in there were getting that nice, healthy extra yield premium. Now there's a bigger rush to the space. And what we're seeing is maybe the difference between those AI-driven deals from the high-quality borrowers relative to your standard corporate bond. That's starting to compress a little bit. I mean, these are huge deals, but on the other hand, remember, this is a very large market. There's still a lot of cash on the sidelines. Bonds and the broader fixed income market continues to attract more investors as they look at these nice, healthy coupons or premiums. And so, in long short, I think the market can absorb this issuance. It's more about the question about this issuance in the AI side and the data center driven side is like over the next 12 to 24 months, will there be a disruption or a hiccup in the market's basically view of the demand for those data centers? Maybe technology changes so quickly that we're overbuilding. And if we're overbuilding, then again, I'll get back to my point earlier, you're going to have winners and losers, and there might be some pain to be had if people went too fast from a bond investment perspective into this area.
Brian, let me also ask you this. When you look at the economic backdrop right now, is it sort of AI and everything else in terms of the growth is coming from that and the build out, and everything else is kind of plugging along, or maybe not even that?
Yeah, I think that's actually well said. In the equity market, it feels like it's AI and everything else, and it's pulling standard averages and PE ratios incredibly high, and in the bond market, same thing. That's kind of where, whether it's in the public side or the private side, the data center, the AI driven euphoria has really certainly got everyone's attention. I think as an active investor, a bond manager who manages a lot of strategies, and we're active, we have the ability to kind of maybe go where others aren't paying attention. And I think that's the point of an active value investor. So, maybe why the whole world is just kind of, in their AI craze, and they want that exposure, whether it be equity or fixed income. There's big other parts of the fixed income market that are kind of being forgotten about. And it may be similar to what it feels like in the economy right now. Some things feel strong, and there's other parts about, let's say, the kind of the lower kind of segment of the consumer segment who are struggling, both to kind of make their bills, and obviously the employment data isn't looking great. And so it's the same thing on the bond side. There's kind of forgotten markets that still offer, we think, really good value, and that's kind of parts of the securitized market and really high quality things like agency mortgages. I think you can't just kind of look where everybody else is going. You gotta see what everybody else is forgetting about as well.
So Brian, just linger on that for a moment. Those sort of underappreciated areas of the market for a retail investor or somebody who's looking at the composition of their 401k. Where should they be looking then?
I think the most important thing I would advise a retail investor or any investor in retail institutional is, look, I don't know where the equity market ends. I don't know where it tops out. I think it's topped out, but it may be a lot higher from here. But what I would say is, remember, in bonds, you're only getting back par. That's it. It's a loan. Like your upside is basically what you lent to the borrower. And so, keep that in mind. So you kind of want, you don't usually get paid to be in the parts of the economy and the bond market that everybody wants to talk about in the cocktail hour. You basically want to make kind of really good, sound investments. And so from a fixed income perspective, what are we trying to do? We're just trying to generate very good income for our clients, good total rate of return. We want bonds to perform like our clients expect them to. In their overall portfolio. Mm-hmm. And so that's my recommendation. You can express those euphoric views maybe in your equity portfolio because you actually might have the upside. In your bond portfolio, you just want to kind of be straight down the middle, like your 4-iron, on the golf course. Yeah. Get your coupon, get your income, and keep your liquidity.
Brian, thank you so much. Really appreciate it.
Thank you.
We'll be back. Shares of Circle are falling after the company posted results for the latest quarter, its second public report after its IPO earlier this year. The stablecoin maker reported strong results for the quarter, topping Wall Street's expectations, but investor concerns about falling interest rates is weighing on the shares. For more on what's next for Circle, Jeremy Foxkeene is joining us, the company's chief financial officer. Jeremy, thanks for being here.
Julie, thank you for having me. It's great to be here.
I'd like to talk about the quarter first, because you guys saw a big uptick in the stablecoins under circulation, I think to $75 billion now. How would you characterize the quarter, and what do you want investors to know about it?
So this, for Circle, was a terrific quarter, our second now as a public company. We saw strong growth in our core products. USDC in circulation grew 108% in the quarter, and the usage of USDC grew 580% in the quarter, with on-chain transactions growing to 9.6 trillion. So we saw strong underlying product growth. We also expanded our platform with the launch of our Layer 1 blockchain ARC in testnet, and with continued and sustained growth in the Circle Payments Network. So we had strong underlying growth, we expanded our platform, and we also delivered very strong financial results, with revenue and reserve income up 66% to $740 million, and net income up 202% to $214 million. So this was a very strong quarter. But I'd remind everyone that we're in the early days of what can best be characterized as a mega trend, the building and the growth of the internet financial system, right, which is comprised of blockchains, of digital assets, and of the applications that are built on top of them. And Circle is the platform company that is building in each of these areas. We're market neutral infrastructure, and increasingly the world's leading companies are choosing us to build upon. So we feel very confident both with the quarter and for the long-term growth trends ahead.
Well, I guess Jeremy, it's the sort of middle part of that, perhaps, that investors are concerned about, right? The long-term growth as you build out those other revenue streams is one thing, but in the very short term, we're seeing interest rates falling, and so that means that the treasuries you hold to back up USDC are going to be yielding less, right? So you guys, as you mentioned, revenue at $740 million. How much of that is the income that you're getting from treasuries?
Well, the majority of our revenue today is from our reserve income, which is money we earn on the assets backing our stablecoins. As you mentioned, our other revenues, which are growing strongly, they're very modest in scale today. As we look to the future, however, I talked about a mega trend. The right way to frame our business is at the beginning of one of these very, very long growth trends. And so as you look at any exponential growth curve, right, when you zoom in on the short end of that curve, you're going to see fluctuations, you're going to see ups and downs. From our perspective, overly worrying about short-term fluctuations in this metric or that metric in the near term is in some ways is missing the forest for the trees.
Well, I guess, again, the timeline is important, right? Because if the majority of your revenue is now those reserves, and at some point in the future, as we see those other revenue streams ramp up, you expect it to be more diversified, kind of when do we get there? Especially since it doesn't seem to be that we are at the end of a rate cutting cycle. So the situation could potentially get worse before it gets better. So how are you managing investors' expectations around, sure, if you're going to make this bet that in the long term, you'll get that revenue, what's the short-term pain look like before you get to that?
Yeah, so you just phrased it very, very accurately. We're not at the end of a rate cutting cycle, but we've been in one. And through the beginning of this rate cut cycle, we have seen tremendous growth in circulation. We've seen tremendous growth in our revenues and reserve income. As I said, that's up 66% this quarter. And net income's up 202%, and adjusted EBITDA is up 78%. And as you noted, these are handily beating street expectations. So we're already in a rate cutting cycle. And through that cycle, we are delivering sustained growth. In many ways, we think falling rates are good for our business in the near term.
And walk me through that. How do you see that?
Falling rates lead to greater economic activity. They lead to greater risk-taking. They lead to greater investment. Falling rates accelerate along the path to the future that you rightly called out, as we could see where the end is, and the question is how to get there. As we go through this rate-cutting cycle, we have been seeing accelerating growth and accelerating financial performance, and we would expect that to continue.
I mean, I suppose that presupposes that the rate cutting is enough ahead of the economic weakness that it forestalls it, right? In other words, obviously, if you're cutting rates because of economic weakness, the hope is that the economic weakness doesn't then overtake it. So I guess, how concerned are you about the macro environment writ large if the reason behind rate cuts is, say, a weakening labor market?
So again, I just bring back to the long point, and you just said it with macro, right? We are building for the future. We're investing in our distribution. We're investing in our product platform. And those investments appear to be paying off.
Okay, let's talk about some of these investments as well, because I know you guys talked about ARC and you guys launching a native token. Can you talk me through that, and as one of the opportunities that you're talking about, what the potential there is?
So the ARC blockchain, right? We've launched it in testnet with over 100 of the world's leading companies choosing to build alongside us and test alongside us, which we think is a real endorsement. This is almost, if you like, a fourth generation blockchain. The blockchains that came before were incredible inventions and incredible technology advancements, but they're not optimized for bringing economic activity on chain. And as where I started this, we're grounding ourselves in building, the new internet financial system, and that is about bringing the world's economic activity on chain. And so the ARC blockchain is optimized to do just that, right, with various technical and design choices. For example, it has native privacy built in. which is a requirement for leading institutions to be able to conduct their economic activity in a blockchain environment. It has, instead of relying on native tokens, and you just mentioned that, and I'll get to that, to pay gas fees, transaction fees. Transaction fees are payable in USDC, they're payable in money. And there's a number of other design choices that lead to that optimization, which is why we're seeing not only our excitement, but the excitement of the builder community around it. So we announced this morning on our earnings that we were exploring issuing a native token on Arc. And there's a wide range of elements that come to bear in that. I think on our earnings call, we highlighted sort of the potential for sort of distributing governance over the technologies and the blockchain and how it evolves. And so this is early days in that exploration, and we'll keep the market appraised as we go forward.
Jeremy, thanks so much for your time this morning. Appreciate it.
Thank you so much. Good to be here.
Thanks. We got much more markets action coming up, including a check on some trending tickers and calls of the day. We'll be right back.
Welcome back to Yahoo Finance. I'm Brooke Tafama, live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of AMD, Oklo, and Carvana. First up, AMD, that stock moving higher this morning after AMD outlined a path to deliver adjusted earnings per share of more than $20 alongside an annual revenue growth rate of more than 35%. Now that led Wells Fargo to raise its price target on the stock to $345, up from $300. It's one of the most bullish price targets on the street with a 12-month average of $280. There are currently 50 buy ratings, 15 holds, and 1 sell rating on the stock. Next up, we're taking a look at shares of Oklo. That stock getting a bit of a pop this morning. B. Riley Securities raised its price target on the stock to $129, up from $58. And Cantor Fitzgerald raised its price target to $122, up from $84. This comes after the nuclear tech company missed expectations in its quarterly results, but Wall Street is optimistic about the approval from the U.S. Department of Energy for its nuclear safety design agreement. And last up, we're taking a look at Carvana stock. That stock also getting a nice boost today. Barclays initiated coverage on the stock with an overweight rating and a $390 price target. The firm thinks the company is well positioned to gain share in a highly fragmented used vehicle market. That price target, though, is still well below the 12-month average on the street, which is $419. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching Anthropic, Synopsys, and Clearwater Analytics. First up is Anthropic, the AI startup announcing plans to spend $50 billion on its U.S. AI infrastructure build-out. The company will start by building custom data centers in New York and Texas. The facilities will be developed in partnership with FluidStack, which is an AI cloud platform. The spending designed to support Anthropic's rapid enterprise growth and its long-term research agenda. The project expected to create 800 permanent jobs and more than 2,000 construction roles. Additional sites are expected to follow, with the first locations going live in 2026. We've heard a lot about OpenAI's build-out plans. Anthropic, which operates the chatbot Claude, this is some more information on its plans. Next up is Synopsys. The company will lay off about 10% of its workforce amid a restructuring. About 2,000 employees will be affected by those cuts. The move comes after Synopsys completed its $35 billion acquisition of engineering design firm Ansys, the chip design software maker looking to redirect investment toward growth opportunities. That's according to a filing. Synopsys told Yahoo Finance they do not take these measures lightly, and they're committed to treating impacted employees with respect and to provide support through the transition. And finally, Clearwater Analytics, the company considering a potential sale after receiving takeover interest, according to Bloomberg. Clearwater was founded in 2004. It provides software to companies in the financial services sector. Earlier this year, Clearwater completed an acquisition of Infusion. It's a software provider to asset managers and hedge funds. That deal was valued at about $1.5 billion. The stock, Clearwater's that is, has lost about 33% of its value this year. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, find out whether it's better to rent or buy in the current housing market. That's next on Market Catalysts.
While mortgage rates have been trending lower, Americans are not ready to jump into home ownership. Among renters who intend to move within the next year, 59% plan to continue renting. That's according to a recent Zillow report. But is that the best move? Well, here to examine the housing landscape, we welcome in now Zillow Group home trends expert Amanda Pendleton. Amanda, it is good to see you. I want to start here, Amanda. You say it now takes the average homeowner 7 to 9 years for owning to make more financial sense than renting. Let's stop there. What do you mean by that, Amanda? More financial sense?
Yeah, so this is the buy, rent, break even point, the point at which it does make more financial sense for you to buy than to rent. And that really takes into account a combination of factors. So, of course, there's mortgage interest rates. So how much of your monthly payment is going to interest versus principal? And of course, like rent, that just disappears. You're never seeing that again. And then there's home value appreciation. And right now, home values are pretty flat, and they're expected to rise at less than 2% year over year by next summer. We also look at rent price growth. So how quickly are rents growing? And then, of course, opportunity cost. How much could your down payment appreciate if it were invested in the stock market versus in the housing market? And it really is the combination of those factors that makes it say, okay, the break-even horizon is so much longer than it was prior to the pandemic.
Some of the regional differences you point out, Amanda, are also really interesting. This struck me. Cities like New York or San Francisco, it can now take 15 to 20 years to break even on buying. Did I see that right?
Yeah, it's absolutely wild. So you're right. Nationwide, 7 to 9 years is the break-even time horizon for where it makes more sense for you to buy than to rent. But in those really expensive coastal metros, in New York City, in San Francisco, you're looking at 15 to 20 years of staying in the same place before it makes it more financial beneficial for you to have purchased that home than to rent that home. Now, in more affordable metro areas like a Memphis or a St. Louis, you're looking at 3 to 4 years before you break even on a home. But just for perspective, compare that to prior to the pandemic, and the buy, rent, break even point then was 2 to 3 years nationwide. So it was an absolute slam dunk to buy versus to rent. That calculus has really changed.
So you would argue, Amanda, correct me if I have this wrong, that renting then right now could be, rather than sort of a temporary step to eventual home ownership, are you arguing it could be actually a smart, long-term financial option for viewers who are watching this?
Yeah, so what we're seeing now is this rise of the lifestyle renter, right? These are people who could afford to buy but are choosing to rent because they want the flexibility and the freedom and the ease that comes with renting. Look, I think the decision to rent or buy is really personal, and it does come down to two things. It's who you are, and it's how long do you plan to stay somewhere? And the who you are question is that lifestyle question. Do you value flexibility? Do you not want to have to do yard work every single weekend? Or do you want that backyard garden and you want a menagerie of animals, right? Those lifestyle choices are going to be as, if not more important than the financial questions right now.
Amanda, let's say there's a viewer watching this, though, and they're listening to this, but you know what? At the end of the day, their dream is still owning a home. What would be your advice to that viewer, Amanda? Would you say, hey, focus on smaller markets, focus on a smaller home, shop around for a mortgage, maybe wait for a bit? What would be your guidance?
Yeah, look, home ownership absolutely has a lot of benefits in this country, right? You've got wealth building. You invest that 20%, you get equity on 100% of your home's value. There's tax benefits too, right? And you get that stable housing payment for the next 30 years. So there's a lot of great things that come with buying as long as you plan to stay somewhere for a while. So I would say, number one, you got to get your financial ducks in a row, right? You got to improve your credit. You got to improve your debt to income ratio, boost your savings. This will all help you land a better interest rate. So those monthly payments are going to be lower. And then figure out what you can really afford. And there's a lot of great tools out there. We've got one on Zillow called Buyability. It's on the app, shows you exactly what you can afford on a monthly basis. And then you can shop by your buyability. So you're only seeing the homes that you can actually pay for. And then finally, I'd recommend forming a team of experts, right? You got to have a great agent, a great loan officer on your side to give you a competitive advantage, and make sure that you're ending up in a place that you truly can afford for the long term, and that's going to work for you and your family for the long term.
Amanda, I'm here. As you look into 2026, a lot of the trends you're highlighting here, Amanda, do you expect them to persist? Or might we see some changes in the trends and themes? For example, investors certainly expect the Fed to cut, Amanda. How does that play into this dynamic?
Look, I think any kind of cuts in mortgage rates, any reduction in prices is going to help affordability, and that's going to be a good thing. That's going to bring more buyers to the market. That's going to make home ownership more affordable for more people, and it's going to shrink that buy, rent, break even time horizon. That said, you mentioned this off the top, that we're seeing nearly 60% of all renters plan to continue renting next year. And we asked them, if mortgage rates were to come down dramatically, would you still be renting? Only 37% of people said even if mortgage rates came down, they would buy a home. So we're still seeing a lot of people in the rental market who plan to stay in the rental market for the long term. And a big part of that is the lifestyle reasons that we talked about.
Amanda, great to have you on the show today. Thank you.
Yeah, thanks so much, Josh.
The economy is facing a tug of war of sorts between a slowing labor market and persistent inflation, and that's carved out a split among Federal Reserve officials with regard to a December rate cut. So how can ETFs help you make money in this uneven environment, or maybe insulate you? With me on set is Steve Laidley, BlackRock Global Co-Head of Bond ETFs, for this week's ETF report brought to you by Invesco QQQ. Good to see you, Steve. Thanks for being
Julie.
here.
Thanks for having me.
So we are in this uncertain environment, both from an economic standpoint and from a what's the Fed going to do next standpoint. So given that, how do you sort of attack your strategy?
Yeah, and I think this kind of reinforces what we've been saying for a while, which is it's a tremendous environment to invest in fixed income. So this latest, sort of hesitation amongst, Fed members about whether they will or won't, actually is an opportunity in our view, because, it allows you to still lock in these yields. Because at some point they probably will resume cutting. I mean, the market's still pricing in, a solid 3 to 4 cuts over the next year, right? So, for us, we think it's a great time just to keep locking in those yields. And yeah, credit spreads are a little bit tight, but it doesn't take much to be able to really get good income, locked in over the next few years, right? You don't have to go that far out on the curve, as an example.
And does it really matter if the Fed cuts in December or in January? I mean, except I guess for the idea of timing of trying to lock in those yields.
Yeah, I mean, so this gets to the idea of the market itself. In theory, it's all priced, right? But there's but the uncertainty does give you a little bit of room, where, maybe they don't cut and then there are more cuts later or something like that. So it's the path that kind of matters. I think most investors are settled on the idea that there will be more, but it just gives you a chance to be able to move, out of that very, very front end and lock in something a bit longer, because it is, if you think back, you go back, 5 years, right? We didn't have this. So it's it's the first time you put income back into fixed income. And we've been saying that for a while, understandably, but it's just a great opportunity while we're at these levels.
Okay, so let's talk about that shift a little bit, because we have seen, retail investors certainly, but institutions as well, pouring into things like money markets, right? Because they were yielding something meaningful for the first time in a long time, and they're also very liquid. But now, how should you be shifting? How exactly should people be going about doing this?
Yeah, and there are ways to do this. And obviously, we've talked about, investors' risk appetites, right? So for example, SGOV is a good way to kind of start moving out of SGOV, moving out of, time deposits or CDs. You're still getting close to a 4%, right? And then that's our 0 to 3 month T-bill fund. But then you can go further out, right, into something like NEAR, NEAR, which is still short duration, but the duration expands out a couple years. And then you can go out further into something like BINC, B-I-N-C, which is our CIO Rick Reeder's fund, which is an income-focused fund, but it's actively managed. So it's trying to monitor the duration and credit risk, et cetera. But, it depends on your risk spectrum. Investors will start moving out a little bit, into shorter maturities, and then, gradually, we would even say, for a while we were, I think, very, very cautious on the long end, but you are starting to see a slowdown in the labor market, right? If that picks up, you probably do want to own something further out on the curve, right, and longer maturities.
And how do people need to be thinking about this in balance with their equity holdings, especially with all of these questions out there about whether the equity market's getting toppy?
Yeah, and that's something that's been hotly debated, right, since the tightening cycle, which for a while the correlations were such that fixed income really wasn't offsetting equity moves. And it's interesting because if you go back in time, and we looked at this, you can go back, mid last century, and it's been all over the place. And a lot of times it was positively correlated, negatively correlated. But I think, now you probably will see the long end fall if labor markets slow sharply, right? And so something, further out on the curve like an IEF or even, TLT has been, a huge flow for us, over a number of years. SGov kind of took that crown this year with 30 billion. But, it makes sense to kind of spread your bets a little bit.
And then just writ large, do you think that investors are adequately, allocated to fixed income right now, given the gains we've seen in equities and the money that's poured in there?
No, I think we still think investors are underinvested in fixed income. So, you still have, depending on your metric, I think 7 trillion, maybe even, closer to 9 in money market funds. You probably do need more ballast in your portfolio, right? You need more income in your portfolio. So, even something like I-bonds, right? A great way, some people are not comfortable with, sort of the perpetual nature of a bond fund, something like an I-bond where you do have a fund that matures, right? That's kind of an in-between step where you can lock in a yield, let it roll down the curve like you would a normal bond, right? That's a good way to sort of still add income and ballast to the portfolio. We've seen, 70 billion flows into that category. We've seen, overall this year globally, we've seen like 150 billion go into fixed income. It's still, I think investors are still underinvested in fixed income
Even
relative
with
to the
all
opportunity.
that. Wow.
Yeah.
All right, Steve, thanks for coming in. It's great
thanks
to
for
see
having
you.
me. Yeah,
Appreciate
you too.
it.
Thanks.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.